But it's also amusing because you're going to get some diversity of opinion between me and Steve Weiss, who was just next to me on the screen there. He and I have been at opposite ends of the spectrum here. I am seeing far more positive than negative. And I think Joe and Shannon gave me a lot to work with there. You know, Joe was mentioning crude oil prices. I'm really taking a look at gasoline futures. RBOB, reblended oxygenated blend gasoline futures are down 25% in a month. Now, that takes some time to reach the pump, to reach the retail gasoline level. But over the coming weeks, you should be seeing gasoline prices coming down. And while that may not show up in June's CPI report, it eventually will. That should take a little bit of heat from the Fed as far as the fire that they're building to raise interest rates. And to your original question, I think the minutes will show they're ready to go another 75 basis points this month. But after that, if gasoline futures are coming down, that's a major contributor to inflation. It's also a major contributor to consumer sentiment, which we know has been terrible. So if that comes off the mat, you can see consumption picking up, you can see profits picking up. But the bottom line is this, David. Right now, we're in a mood where good news is bad news. You can see that in today's economic reports. The JOLTS survey showed 11 million job openings, which is also almost twice as many unemployed people. That's a tremendous ratio. Jobs are plentiful. And the ISM Surveys Index came in better than expectations and clearly expansionary. The market's down today because we're in a good news is bad news environment. That won't last for long, especially if inflation eases. So I'd look for better times ahead.
All right. Well, Steve, I don't watch the show every day, but I watch it enough to know that you've been negative and been right. You know, anything in what we've been seeing and what Jim just mentioned in terms of the collapse in some commodity prices, yet still strong numbers on the employment front, and kind of a market that sort of seems to be at least trying to find a bottom in certain names. Anything kind of arouse your interest, or are you still negative?
No, the only thing that aroused my interest is Jim admitting that I've been right and he continues to be on the wrong side of things. Look, you know, keep in mind that both increases in rates and easing take a while to actually impact the economy. So we're only really seeing the sentiment impact the economy right now. You know, I had covered my TLT short back on the 17th. I put it out again this morning in advance of the Fed minutes. So the Fed's on a one-way path right now. I do believe you'll see stagflation. There's just nothing out there that gives me any hope at all that the market will bounce. The market's still overvalued in my view.
Why stagflation? Yeah, why stagflation, Steve? Why do you think we're going to see that?
Because I think prices are going to stay stubbornly high. Sure, they're going to come down a little bit. They'll follow commodities coming down somewhat. But you've still got major issues. And it's not just in the U.S. I would say that multiply them and take a look at Germany. Take a look at what's happening with the dollar, which has been referenced, and take a look at Germany that's really offsides in terms of energy. So as you get into the winter months, as you get into the cold months, you're going to see those energy prices go higher again, except for the fact that you see a period of demand erosion. So with 60 to 70% of the U.S. economy, U.S. consumers living paycheck to paycheck, it's just not a good story. So, yes, it's sentiment that's perhaps driving consumer spending lower, but it's also the reality. I believe consumers, and I've said this before, consumers, when you saw COVID, the fears of COVID move away and you saw the economy reopen, you have this fire hose effect, similar to what happened with Peloton on the positive side, this fire hose effect with vacations, with going out to restaurants, with going back to malls and buying. And then the consumer got rid of that emotion and said, hey, you know what? I'm left with all these big bills. So while, yeah, wages have gone up somewhat, and the JOLTS, by the way, Jim, is not new news. There's been 10 to 11 million job openings going forward, but we're seeing job cuts by some of the biggest, most profitable companies out there. So overall, I think it continues to be a bad story. And here's what I'd say to, now look, some buyers are not the asset allocators. So the equity managers, so they've got to buy because they can only keep maybe 10 or 20% cash. But otherwise, if I came on this show and I said, look, I bought this brand new car, I'm going to leave it at my driveway for 3 years. And I bought it despite knowing the fact that the price of those cars are going to come down because incentives are going to reappear, you'd say you're out of your mind. Why are you buying a car that you're not going to use for 3 years? So I posit this. Why are you buying stocks when you have to say in 2 years or 3 years they're going to be good buys? Why not just wait and stay in cash, as most of the people that I know that have the freedom of choice of being in cash or being invested are in cash?